Look, the biggest indicator we'd look at is long bond rates. Unfortunately, they have been manipulated lower by quantitative easing. That's just a fact of life in the world that we invest in. And ultimately, those low rates are allowing asset prices to rise. And so anything that threatens that low interest rate environment is a concern to us. And so obviously, the Fed thinking about raising rates is going to create a bit of volatility. Obviously, any concerns around Europe and countries leaving is going to create volatility around rates as well. And so if you're going to look at one indicator in the world, you look at long bond rates because they are underpinning equity valuations. They're underpinning the M&A that's occurring in the world because people can borrow money cheaply and invest it. And central banks, to a certain extent, are manipulating this, which is not very helpful. But that's the reality of the environment we live in at the moment. And so if you're looking for warning signs, it would be anything that pushes rates up outside of strong growth. So that would be inflationary issues or concerns that certain countries couldn't repay their debts.
And is there anything that you're seeing at all on that sort of radar at the moment?
Well, obviously, we've been through the Greece issue and we seem to have kicked the can down the road again. So that's one that's out there that's worth watching. But even if Greece was to leave the euro, I do think, in our opinion, the other countries are pretty much committed to staying the course. In the US, they're talking about hiking rates, and so that could cause some volatility in rates. But ultimately, the big problem we have is we don't know who's invested in all these products, quite frankly. I mean, to us, it doesn't seem a lot of logic to buy Portuguese debt at 2%, quite frankly, on a 10-year basis. It's not a great return. And so I suppose we worry as to the money that's gone into these instruments. If it turns around and comes out quite quickly, it's not the Fed that controls the long bond; they only control the short bond, and that's I suppose our source of worry as to who's dislocated in bond markets will hurt equity markets, and that's why we watch them very closely.